Swayam Prabha. Digital India. Educated India.
Introduction to real estate valuation. This is our topic for today in course Real Estate Finance and Investment Strategies. So first, what is real estate valuation? So we'll first have a brief definition, then we'll talk about some key application, and we'll try to answer the central question, what is the property worth? So real estate valuation is fundamentally a systematic analytical process designed to determine the economic worth of a property interest at specific point in time and for a particular purpose. So this definition encompasses several critical elements that distinguish professional valuation from casual price estimation. The systematic nature of valuation requires adherence to established methodologies, professional standards, and logical analytical framework. Unlike subjective price opinion, professional valuation must be supported through market evidence and recognized valuation principles. The application of real estate valuation span across multiple sectors of the economy. So in mortgage lending, valuation forms the basis for loan to value calculation that protects lenders from excessive credit exposure. So here we have to understand that how much loan in percentage terms to overall value can be given. So a valuer, property valuer will ascertain property valuation, and then they will decide, the lender will decide that what amount of the total they can lend in this and how much risk they are willing to take. So LTV ratio is coming from there. So mortgage lending is one area where we require this process. Then investment decisions, whether by individual investor or institutional fund managers, rely heavily on accurate property valuation to assess risk adjusted returns and portfolio performance. And then we have legal proceedings. So there in the frequently we require valuation opinions for dispute resolution, for compensation. So for these matters we require real estate valuation there. And then we have tax assessment, that is how much property tax, insurance coverage, all that has to be there. So that is again something for which we do valuation. So why, what is this property worth? So that is the moot question which we answer through real estate valuation. So moving on, we have valuation complexity. Now real estate has a unique characteristics. Some of these characteristics we have learnt earlier. For example, heterogeneity. One same building, one flat is different from another flat. We know that one is sea facing, one is not. So there is a big difference in price. One is corner, one is not. So there is a big difference. Then immobility. They are fixed in nature, so they cannot move. So there is a immobility thing. Then durability. For long lasting, unlike some other type of investments, real estate is a durable proposition. Generally, we make investments in real estate for long term. And then high value. High value is generally there for real estate, very big amount. Sometime a significant portion of our wealth goes into real estate. And then there are infrequent sales. Unlike share market where there is a frequent transaction, sale of real estate might not be that frequent. Now these all complex things affect valuation. So there is no identical properties. So same area, different values for the same in the same building, two different flats, two different prices. Again valuation coming. location permanently fixed, that is impacting. So if there is a issue in that area, some change has happened, some regulation change has happened, specifically that local bylaw, so that is impacting. You cannot do much about it. Then long-term considerations that impact valuation, and similarly high value and infrequent sales also play a crucial role in valuation. So valuation also becomes impacted by these characteristics. Then types of value we are talking about. So here we can see that we have market value, investment value. So talking about market value first. So market value represent the cornerstone of most valuation assignments and reflect the most probable price that would be established in a competitive market under normal conditions. So this concept assumes willing participants, adequate marketing exposure and arm's length transaction terms. Then we have investment value. So investment value in contrast represent the worth of a property to a particular investor based on that investor's specific circumstances, requirements and expectations. So investment value may exceed or fall below the market value depending on factors such as the investor's cost of capital, tax situation, risk tolerance, strategic objectives, all that. Then we have liquidation value, addressing scenarios where properties must be sold quickly under distress circumstances, typically yielding value substantially below normal market level due to compressed marketing periods and urgency factors. And then we have supporting value concepts, including assessed value used for taxation purpose, replacement cost for insurance application, and reproduction cost for specialized legal proceedings. So each serves specific professional and regulatory requirement within the broader valuation framework. Then we have market value definition. So we have talked about this. So what is the definition? So estimated amount for which property should exchange between willing buyers and sellers in arm's length transaction after proper marketing. So this is international standard valuation standard definition which is there, and this definition deserves careful analysis to understand its constituent elements. So we can see the phrase estimated amount that acknowledges that market value represent a professional opinion based on analysis rather than a precisely determined figure. This estimation process requires professional judgment applied within recognized analytical framework. Should exchange creates a hypothetical transaction framework under ideal market condition, distinguishing market value from actual transaction prices that may be influenced by the individual circumstances or market imperfections. Then the requirement for willing buyer and willing seller eliminates transaction involving duress compulsion or distress circumstances that might not reflect normal market motivations. And then we have arm's length transaction, which excludes sale between related parties or transaction influenced by special relationship that might affect pricing decisions. And then proper marketing assumes adequate market exposure through appropriate channel for a reasonable period, ensuring potential buyer have opportunity to discover and evaluate the property. So basically a holistic definition which is telling us that if the whole process has been transparent, the process has not been done under duress, and basically the normal market conditions are there, and when the transaction happens, that kind of market value we are talking about. So willing parties, proper marketing, knowledgeable participants, no compulsion, and current conditions. So all that is basically market value. Then we have investment value concept. So value to specific investor based on individual criteria. So we have basically, let's take one example here. So the same office building in Mumbai might command different value from different investor perspective. So let's say a REIT manager constrained by regulatory requirement but benefiting from low cost public capital might value the property at 45 crores based on an 11% required return. Private equity fund, that is your PE fund, equity fund targeting higher returns to compensate for illiquidity and management intensity might apply a 18% return requirement, resulting in a 38 crore valuation. Meanwhile, a family office with patient capital and conservative return expectation might reach a 42 crore conclusion. So, these variations reflect fundamental differences in cost of capital. So, investment horizon, risk tolerance, tax circumstances and operational capabilities, all of these are impacting their judgment. So, the market value of 40 crore represent the consensus view of typical market participant operating under normal conditions. So, we can say that somewhere around 40 crores is something which is coming out. So, this example demonstrates why understanding the purpose and context of valuation is essential for selecting appropriate methodology and assumptions. So, investment value calculation requires explicit consideration of investor specific factors that are excluded from market value determination. So, this is one way to see this. Then we have fundamental principles, core valuation principles. So, we will take them one by one. So, principle of highest and best use establishes the analytical foundation for determining optimal property utilization, recognizing that land value is maximum when put to its most productive, legal and feasible use. The substitution principle provides the substitution principles provides the theoretical basis, second one provides the theoretical basis for all three major valuation approaches, recognizing that rational market participants will not pay more for a property than cost of acquiring equally desirable alternative. So, that is understandable. Then coming to the third one, that is contribution. So, contribution principle addresses the relationship between component costs and value additions, acknowledging that expenditure on property improvements do not necessarily translate to equivalent value increases. Then anticipation principle recognizes that property value reflects expectation of future benefits rather than historical cost or past performance, emphasizing the forward looking nature of this investment decisions. And the change principle acknowledges the property values are continuously influenced by evolving economic, social, physical and government factors that affect desirability and utility. And then we have the balance principle addresses optimal combination of production factors, land, labor, capital and coordinates to achieve maximum value creation in property development and management. Then coming to highest and best use. So, this one is basically we have the four tests of highest and best use. So, let us take them one by one. So, legally permissible requires examination of zoning regulation, building codes, environmental restrictions and other government limitations that might constrain property use. Then physical possibility analysis considers site characteristics including the size, shape, topography, soil condition and access that determine feasible development alternatives. And infrastructure availability and capacity also influence physical feasibility determination. And then we have financial feasibility requires demonstration that proposed uses can generate sufficient return to justify the investment requirement for implementation. So, this analysis considers both development cost and projected revenue under realistic market assumption. The maximal productivity test requires comparison among all legally permissible, physically possible and financially feasible alternatives to identify the use generating the highest residual land value. The Mumbai mill land example is a very interesting example. This principle, this example basically explain the principle's practical application. So, former textile manufacturing site in Lower Parel and similar area have been converted to mixed use development, generating values 10 times higher than their previous industrial value. demonstrating how highest and best use analysis guides optimal property utilization decision. So, earlier it was used for industrial use, but then that property as the area grew, its importance grew, and when it's the way it is used, it is changed. There is a significant appreciation in price, 10 times its industrial, when it was being used as an industrial land. From there, a 10-time appreciation was seen. So, that kind of change, because the best use was not industrial, but utilizing that precious land for maybe commercial, for residential purposes. So, the next one, which is substitution and contribution principle. So, in this, buyer won't pay more than the cost of equivalent substitute, of course. So, basis is basically that if we have something which is of equal level, everything is same, and we have a specific price for that, then why should I pay extra for something similar? So, that substitution, if it is being applied and some same kind of value is there, then there is no sense in paying extra. Then we have appraisal process. So, we have basically 6 steps to find out this. So, in this appraisal process, professional real estate valuation follows a systematic process. So, first is problem definition. So, problem definition represents the critical foundation step requiring clear identification of the client, intended user, right, purpose and intended use, this type of value being estimated, effective date and property rights being valued. Inadequate problem definition frequently leads to inappropriate methodology selection and unsuitable conclusion. Then we come to scope of work. So, scope of work determination involves planning the research and analyzing necessary to produce credible results. This include identifying appropriate valuation approaches. Then we have data collection, 3 categories: general data regarding market condition, trend, specific data and subject property characteristics. So, all this is there. And then application of valuation and approaches requires professional judgment. So, professional judgment comes into picture. And finally, we document the analysis, and that is how this whole process will be done. Then we have 3 valuation approaches. So, we have sale comparison approach relies on substituting principal by analyzing recent sales of similar properties and adjusting for differences to estimate the subject's property value. This approach proves most reliable when adequate comparable data exists and works particularly well for residential properties and standard commercial assets that trade frequently. Then we have income approach, capitalizes a property income generating capacity to estimate value reflecting investor behavior, income producing real estate market. So, office building, retail center, all of that will be done like this. And then we have cost approach, estimates value by adding land value to the depreciated replacement cost of the improvements. The methodology proves most reliable for newer properties, special purpose buildings, limited market activity, properties where reproduction or replacement represent a realistic alternative to purchase. So, basically in next few lectures we will be in detail talking about them. So, sales comparison process, that is research, verify, compare, reconcile. We will find a proper comparable, and we will, after this proper comparable, we will try to ascertain the value. Then we have income approach formula or process. We will find out the right income which the property can generate, and then accordingly we will try to use it for the purpose of valuing a property. So, basic capitalization formula: property value equals net operating income divided by capitalization rate, right. So, provides a simplified framework for understanding this approach. However, professional application requires careful analysis of each component to ensure accuracy and reliability, right. And we can see that gross income here is rental plus other income, operating expenses means taxes, maintenance, management, NOI means gross income minus expenses, and cap rate is your market return driven rate, which we have discussed in previous sessions also. Then we have income approach formula or income approach of valuation. So here we have example of this office where we have gross income given, operating expenses given, we have NOI, we have capital rate, and just like that formula which we discussed, we calculate the property value, and which is coming around 34.6 crore. So this is one simplified example for that. Then we have cost approach, the third approach in the process that we can use. So in this approach, land valuation within the cost approach typically employs sales comparison analysis of recent vacant land transaction, adjust for difference in sizes, location, zoning and development potential. Land value should reflect the property's highest and best use rather than the current utilization if different, right? And then building cost estimates requires determining current replacement cost using contemporary material, labor rates, construction techniques and regulatory requirement, right? And then replacement cost typically differ from reproduction cost, which would recreate the exact existing structure using identical material and method. So replacement is little different from your reproduction cost. And then we have depreciation analysis that addresses three distinguished categories: value loss. So basically physical deterioration will be part of it, wear and tear, age related degradation, functional obsolescence and economic obsolescence. So all that will part of the depreciation that will be subtracted from this, and this is how you will come up with a cost. Then we come to Indian regulatory framework here. So we understand that RBI is there, it is setting out certain guidelines for lending, that lending guidelines are coming from there. So that is impacting valuation of real estate in India. Then SEBI, it controls REIT and capital market rules. So because they are important players in real estate market now, so they are being governed by SEBI rules. And then IRDA is impacting insurance, and IOB is your professional value registration, even though the first three are regulatory bodies and they impact the guidelines which indirectly impact the valuation. So these are some regulatory bodies which are there. Then coming to the Companies Act, it has its own impact. So Companies Act introduced significant changes in 2013 to corporate valuation requirements through the establishment of registered valuer system. These provisions mandate professional valuers for specific corporate transaction and establish qualification requirement for valuers conducting such assignments. So mandatory valuation scenarios include related party transaction exceeding prescribed thresholds, share buyback programs, merger and acquisition transaction, and financial assistance for share purchases. So these requirements aim to ensure arm's length pricing and protect minority shareholder interest. That is very important. So the registered value framework establishes three asset classes: land and building, plant and machinery, and security, right? Security or financial assets. Then registration requirement include specific educational qualification, minimum experience level, and successful completion of examination process where applicable. So a standardization of property valuers is being done here. So professional standards for registered values emphasize independence from the client influence. Client influence should be less, competence within assigned asset classes, and comprehensive documentation, supportive valuation conclusions should be there. So 3-year registration validity period. So basically this whole system is there to have some standardization in the process. Then we have RERA impact on valuation. So we in previous classes we have discussed that RERA is an important landmark provision which has come up, the rules which are there, which are regulating real estate market, making it more transparent, RERA has also some impact on valuation. Let's see what are these impacts. So, first is standardized carpet area measurement. So, very important. Earlier there was different yardsticks for measurement, built area, super built up area. Now there is a standardized carpet area measurement, a fixed definition given by RERA. Then there is a real time project monitoring, that timely updates have to be given. So that is also impacting valuation. Escrow account financial tracking, that is also playing a crucial role. And then timeline commitments with penalties is also there in the RERA provisions, and all this is basically impacting the real estate valuation. So what are the benefits? We have better data quality, we have reduced risk, and we have improved investor confidence in the whole process. And also the valuers, because now whatever value they are prescribing for a particular property, that value which they have ascribed is very close to what market reality might be. Then we have professional valuers. Now we have to understand that professional real estate valuers serve a critical link between complex market data and reliable valuer conclusions. The competencies and responsibilities of these professionals directly impact the quality and credibility of valuation opinions used throughout the economy. Core responsibilities include conducting independent market analysis free from client bias or predetermined conclusions. This independence requirements distinguish professional valuation from advocacy or consulting service that might favor particular outcomes, right? So that is there, and all this is being done in the ambit of regulation. So regulatory compliance maintenance is there, and that are the aspects which touch a professional valuer. So it requires technical expertise, market knowledge, it requires legal understanding, professional ethics, and all of them together makes a good professional valuer. Then we come to banking application. So we have seen that in mortgage we have bank deciding on the credibility of property, the credibility of person who is availing loan. So that also includes property valuation. So there is a team in banks, in housing finance companies, which look into the property, its papers, its location, it's basically they determine the value and then accordingly decide on the loan amount for that property. So LTV calculation, risk assessment is there for home loans. Commercial lending, income verification has to be done. So the person's income, and then that plays into it. Then collateral evaluation is done, and then portfolio management. It is regular re-evaluation for risk monitoring. So that will also be done at regular basis, and like RBI requirements also play a crucial role here. So fresh valuation every 3 years, approved valuers, specific documentation. So these are some requirements which are there, that there has to be fresh valuation every 3 year, approved valuers only should be used, and third party, basically when third party is being used, and then specific documentation has to be maintained. So all these are basically very prudent way in which RBI requires bank to actually evaluate the valuation, property valuation, and decide on the loan to value of that particular property. Then we go to investment application. So here real estate investment decisions increasingly rely on sophisticated valuation analysis to assess risk adjusted returns, compare alternative opportunities, and optimize portfolio performance. Professional valuers play essential role in supporting these investment processes across different investor type and strategies. Acquisition analysis requires comprehensive due diligence including market value assessment, income verification, expense analysis, and identification of value enhancement opportunities. Institutional investor typically establish minimum return threshold ranging from 12 to 20% depending on risk level and investment strategies. Portfolio optimization also is there. So, portfolio involves regular reevaluation to assess performance against benchmark, identify underperforming assets and guide disposition decisions. REIT and other institutional owners typically conduct annual or semi-annual portfolio reevaluation to support strategic planning and performance reporting. Then we have development feasibility analysis addresses project viability by comparing project development cost with anticipated sale prices or rental income potential. These analyses must consider construction timing, market absorption rates and financing cost to determine project feasibility. Then exit strategy planning requires ongoing market analysis to identify optimal disposition timing and pricing strategies. Professional valuers provide market intelligence regarding buyer demand, pricing trends and competitive supply that influence exit decision timing. So, all these are playing an important role. Private equity example is basically targeting 50 to 20% internal rate of return. This particular thing illustrates how different investor types establish return requirement based on their cost of capital, risk tolerance and competitive position in acquisition markets. Then we have REIT valuation. Now, REIT we have discussed, it is indirect way to invest in properties. Now, REIT, SEBI has a specific requirement for REIT also regarding valuation. Semi-annual independent valuation is mandatory. Registered valuers only for this purpose, they have to hire them, they have to get their portfolio valued and multiple approaches are required for it. Public disclosure in reports, in their reports they have to make public disclosure of these valuation analysis they have to do. So, methodology DCF basically primarily with 8 to 10% discount rate for offices is used. So, REIT is mandated to do valuation of their portfolio and also share it with the shareholders. Then legal applications. So, in litigation support, expert testimony when it is given in court, dispute resolution, then in that case we have valuation done. For land acquisition, when the government is doing land acquisition, they have to give compensation. So, for that valuation has to be done and for that again this is one legal obligation which is there. Then partnership dissolution. So, there is some dispute or there is some dissolution of partnership because of some other reason. A fair asset division has to be done between the independent members now, they are no more partners. So, valuation has to be done. Then estate matter, inheritance is there, somebody is inheriting some property. So, their valuation has to be done. And then standards, so there are enhanced documentation and defensibility requirements. So, for some certain standards, certain processes also we require valuation. So, for these different reasons also, legal reasons, the valuation or you can say property valuation is done. Okay. So, market value versus investment value applications, we can see that there is a divergent scenario. Special use situation is there. So, special for example, hospitals, schools, they have some specific buyers. So, their investors will be different and these investors are they can value these properties higher in comparison to other investors who might not be interested in them. So, special use properties. Then market inefficiencies, some are more informed than others and that can produce situations where they are, because of their extra information about maybe that particular property, that locality, something new, some new rule is coming, some new IT park or some kind of new initiative is being taken and that they are aware of. So, that can also help in taking them decisions. So, that is there. Then synergistic opportunities, there is a situation where a particular company, a particular commercial venture, they can benefit because there is a synergistic application of that particular property to what they are already doing. And then there are some unique investor circumstances where they want to establish their presence in a particular market or some other reason. So there are unique situation which is there for them. So they might bid higher in comparison to what is there in the market, and that may disproportionately impact the market. So these are some divergent scenarios which we can see that there is between the market value and what is the investment value. Then technology. So we understand that measurement, different tools have come in to measure property, their area and everything, laser tool, mobile apps. Then we have data platforms which are giving transaction databases, analytics for better and deep understanding of the real estate market. And then we have GIS system, GIS, location analysis, demographic, that can be done, proper reports can be formed, proper analysis in the form of GIS can be made. And then automated valuation for standard properties, that is there, which can be there. And then there are different platforms now which are coming up like housing.com, Square Analytics, Tiger. So basically they are also giving certain specific AI and different other technological related interventions in the property market, and that is providing help to the valuation area. Then there are common valuation challenges. One is data limitation. There is a scarcity of data which can help in doing proper valuation analysis. So that is a big challenge. So limited comparable transactions, sometimes in some localities, especially in tier 2, tier 3 cities, there are no comparables available for making proper comparison. So that is there. Then unreliable market information, sometimes the opacity of the real estate market in a particular micro market, there is no information available, proper information is available about the property, and that deficit can be a problem. Then informal market segments, certain market segments are not that properly, they are not very in the ambit of formality, so they can also produce less data, so that is there. Then rapid price changes, that is a issue sometimes. Infrastructure development impact, some areas are disproportionately positively impacted by infrastructure development, some are negatively impacted. And then of course regulatory policy definitely impacts this particular sector a lot. And the professional response to all this will be a conservative assumption, risk disclosure, sensitivity analysis, which we have studied earlier also, that will be used to safeguard the decisions. Then quality control framework. So professional standards can be set up which have comprehensive work file documentation, independent peer review process. So we discussed this earlier that in lending business, in the banks, housing loan companies, NBFCs, they have to sometime hire third party also for their lending documentation purpose. So independent peer review is there. Then mandatory continuing education, valuers should be continuously updating their knowledge. Professional liability insurance coverage should also be there, that in case there is a issue with regarding the the way a particular valuation was done. So insurance for that. And then client management, clear scope should be there, assumption, disclosures, progress updates, all these should be there. So for that, in totality, we will have quality control, proper quality control coming out of this. Then we have a case study here of mixed use development. We can see that it has a component, a Pune complex has a component of retail, it has office building, and it has some part of residences also. Now retail component analysis at ground level focuses on sale comparison with other retail properties, considering factors such as foot traffic, visibility, parking availability, and competition. 8.5% capitalization rate affects higher risk and management intensity typically of retail investors. Office component valuation for floor 1 to 5 employs income approach analysis. And so basically we are using different approaches, and all that we are using them together and coming to a total value of 81.7 crores. So this kind of process can be done. individually each unit, each type can be analyzed using different methods, right? So then we have under construction property valuation. So we have compare with ready properties, apply time value discount, we can add construction risk discount, we can consider developer track record. So all of them together, and we can then study under construction property and value it. So for example, we can have, say, let's say the 12% discount is applied in this particular example, that reflects typical real estate investment return expectation for the 1.5-year construction period. Then construction risk assessment addresses potential delays, quality issues, cost overruns, and market changes that might occur during development. And then 5% risk discount is applied to the time adjusted values, recognizing that even RERA registered projects with strong developer track record carry inherent completion uncertainty. So all this is basically done using, and then we can also value the under construction property. Then we can go for professional development path. Now we understand that for valuation there is a there is a requirement of lot of valuers. So you basically a foundational stage encompasses basic education in finance, economics or related fields, combined with introductory valuation courses. Then we have associate level, typically senior supervisor during the first 2-3 years, allowing new professionals to develop practical skills while building market knowledge and analytical capabilities. Then we have senior level position emerging after 4 to 7 years of experience, and then expert level recognition that requires around 8+ years of experience and demonstrates competency in advanced analytical techniques. And continuing education requirement of this 40 CPD hours annually for IOV members ensures ongoing competency development. So these are different ways in which we can see valuation, a valuer's path of progress, career progress, and how they can become better in this particular area. Then we come to specialization opportunities. So property types, there can be residential, commercial, industrial, special purpose, functional area, litigation support, portfolio valuation, development consulting. Then we have geographical focus, metro market, tier 2 cities, client segment, banking, institutional investor, corporate, legal. So what are these? These are the different ways in which professional valuation practice can occur. So you will see that a person can be expert in residential properties, valuer can be expert in commercial property, they can be expert in specific metro market, tier 2 city. So as these are very localized market, basically localized in nature, there is a specific local requirements, specialization requirements are there. So you will see that valuers are also, property valuers are also specialized in specific areas. So whether it is based on the property types, functional areas, some are there for property portfolio valuation, for development consulting, some are expert in specific geography and some type of geography, and then there are some who are expert in banking, institutional investors, corporate or legal. They are more focused on that particular area. So there are different specialization under property valuation specialization is there. Then risk assessment framework. So we have location, which can play an important role, the condition, legal compliance, market position. Then we have portfolio risk, too much geographical concentration. So you will see that in REITs, you will see that even though REIT is a robust mechanism, it is considered safe, kind of fixed income, but you will see that a lot of the properties of REIT, basically if you can call them the underlying of these REITs, these different properties are located specifically in specific areas. So this kind of basically tier 1 cities, metro cities where their office spaces are located. So anything if something which they have not predicted, or that is some kind of situation which happens in these specific markets, it will impact these REITs much more in comparison to say a REIT which has much more diversified portfolio. So these type of portfolio risk are there. Then mitigation, of course, diversification, insurance, regular monitoring, professional management, all these can help in mitigating these risk assessments, these risks, and after assessing them, we can mitigate them. Then let's see one practice problem here. So this is an office building, size 20,000 square feet, rent is 75 per square feet per month. Then occupancy is 85%, operating expense is 30% of gross income, and cap rate is 9%. And we have to calculate the property value here. So first, step by step calculation. So gross income, 20,000 into 75 into 12 into 0.85, that is 1.53 crores. Then we have operating expenses, which is 1.53 into 0.30, 46 lakhs. And then we get NOI of 1.07 crores. And then we can value this property by 1.07 divided by 0.09 to get 11.89 crores. So this is how we can step by step we can go through and calculate the value of this property. Then we can discuss the current market trends which are there. So we have infrastructure development, metro expansion, highways, they are being made. So lot of these developments are impacting the surrounding areas where they be located, and that will impact the valuation. So these things are impacting valuation, property valuations a lot. Then policy changes, we have seen that how RERA has brought transparency in this area. GST has also been implemented, that has also impacted the real estate market. So these compliance issues, they bring a lot of changes. They are continuously impacting the real estate market. Then we also see the this demographic shift, the more and more urbanization which is taking place, rural to urban movement of people. So that is impacting the property prices in urban areas, also impacting the properties prices in rural areas where the people are coming from. And then valuation impact. So we have regular methodology updates, assumption adjustments. So a lot of new guidelines in valuation area itself is being made, sometimes by regulatory body also. So overall, this is what we have observed, that these are the current market trends which are taking place in this particular area. Then we can talk about the international standard adoptions. So we have if we want to go with global best practices, IVS compliances, international valuation standards, they should be followed. Then USPAP elements, so uniform standard principles, that can be there. Then RICS guideline, Red Book methodologies. So these are some international standards which are there for valuation. Any valuer, property valuer who wants to become expert in this area and who is well aware of all the proper rules which are there internationally and both in India, they should be aware of all these standards. And also for the policy makers, they can become certain benchmark which they can use for creating certain processes, rules in India regarding valuation. And there are a lot of benefits of this. Enhanced credibility comes into it. Because of this, investor confidence also comes, like we have seen through RERA, and professional development also occurs. That is the people, the valuers, they also become professional in their area when we bring such type of interventions. Then coming to technological tools, Google Earth for site analysis, very much being used these days. Government registration websites, regulatory body updates. We have RBI, SEBI, they are constantly updating their rules and regulations, and any valuer should be well informed about it. Then property portals for market trends. Property portals are not just viewed by general populace but also by experts. I met one property valuer who was working in a lending company, and even they go through the trends and everything, which is a button click available on these websites. So a lot of trends can be analyzed from these property portals such as housing.com and Magic Bricks, etc. And then we have professional softwares. We have Argus Enterprise, Excel template, GIS platform. We discussed about them earlier also, and they also are very much useful for valuers. Then coming to success factors for professionals. So we have technical mastery, which is important. You should be well aware of valuation methodologies if you want to excel in this area. The valuation methodologies which we discussed earlier, you should be in detail when they have to be used, where they have to be used. You should be well aware of that. Market intelligence, local dynamic understanding should be there, because real estate is very much dependent on local factors. So in your area where you are working, you should be completely aware of all the local criterias, local rules and regulations and everything. And then professional ethics, it is very important because valuer are ascertaining a value for property, and it will be used at multiple places. So there is possibility of error, but there should not be any wrongdoing or mischief on the part of valuer, and that is why valuation should have proper ethics to follow. Valuer should have proper ethics to follow. Then communication skills, proper reporting of whatever valuation is being done, that should be there. Proper client interaction, so that there is a proper transaction of information, proper flow of information between the valuer and the client should be there. So that communication skills is something which they also should work on. And then continuous learning, because as we have discussed earlier, that lot of policy changes, lot of field in field itself, there are a lot of developments taking place. So a valuer should be well updated of their field. Then in conclusion, we can talk about the key takeaways. So value types, we have market versus investment value distinction. We have seen that in sometimes we have market which is impacting value. Sometimes we take into investment into consideration. Then we have core principle, we have highest and best use. We have seen that the best use is used for analyzing the actual value of that particular land. Then substitution, whether something which can substitute it, what is the value, whether it has the same value or not. So that kind of core principles we saw. Then valuation approaches, we have seen sale comparison, income and cost method, which we will discuss in detail also. And then we have professional standards, we have regulatory compliance and ethics, and we have practical application like banking, investment, legal use. So we have seen that not only in direct property market, but in banking, investment, legal also, we are having different uses of valuation. So this is something which was introduction to property valuation. So in next class, we will be discussing the details of some of the methods which we discussed in this particular session. So thank you so much.